Airbnb announced their Q2 earnings yesterday, and strangely, a company trading at a premium to virtually all its peers announced a $2 billion share repurchase program. We'll talk about if that makes sense and more on today's show. What is going on, investors? Hopefully, guys are doing well out there. Time to take a trip to Airbnb. This stock is down over 34% year to date. Over the last year, down about 22%. We have a massive, and I'm talking about a massive $74 billion market cap on this one. Just going off the stats, you're looking at a forward P near 60, a price to sales even higher than that. So it makes it a strange note that when this company announced their Q2 earnings yesterday after the bell, the company announced a $2 billion share repurchase program, which seemed kind of interesting. We'll go into more of that here in a second, but I do want to focus on the results. Revenue came in at $2.1 billion. That was massive, a 56% year-over-year growth. They did miss expectations by about 10 million. We also got guidance for the Q3 as well. The company saying, quote, "We anticipate the highest quarterly revenue in Airbnb history in Q3," and they see that revenue coming in between $2.78 billion up to nearly $2.88 billion. Yesterday, the estimate from Wall Street was closer in the low end of that guidance to $2.78 billion. I'm seeing in the morning after Wall Street's upped their estimates to $2.84 billion, which would be towards now the high end of the Q3 revenue estimate given by Airbnb yesterday. Now, we'll go through all of Airbnb's financials here in a moment. We'll look at the revenues, the profits, the balance sheet. There's actually some really nice things when it comes to Airbnb. I can kind of see why the valuation is so high, considering they have strong balance sheet, strong earnings, and strong cash flows. But I do want to point out that from at least a price to sales basis, it's tough from an earnings perspective when you look at these companies. So I like to look at a sale, and I've got Airbnb on here. I've got Expedia. I've got Hilton. I've got Booking. I've got Marriott, and I have Trip.com as well. Now, some of these stocks do not compare necessarily to each other. When you look at a Marriott, when you look at a Hilton, these companies actually own the physical property, and in some cases, probably the land as well. I consider that a different asset class, and quite frankly, from a price to sales perspective, I think that's why those two stocks get a premium. Not only do they have a premium brand and a dominant position in the hotel marketplace, but Hilton and Marriott trade at about 11 times sales. Interestingly enough, Airbnb is actually traded right in lockstep to them, and in some cases, a premium to two brands that actually own physical real estate and property. I actually compare Airbnb far more to the Expedias, the Bookings, and the Trip.coms, which all trade at a price to sales south of about 6. You're looking at Booking at 6.4 times sales, Trip.com about 5 times sales, and Expedia bringing up the rear at just 1.65 times sales. I look at Airbnb far more in a marketplace, just a facilitator of a transaction. Airbnb's, that's their business model. They're still trading at nearly 10 times sales, which I think personally is rather rich. And then when we factor in the fact that Wall Street has the next foreseeable future over at Airbnb, growing kind of in a mid to occasionally high teens, nearly 20% growth rate for the foreseeable future. On the earnings side, it's a little bit lumpy and not very consistent. So you're paying a massive premium from a price to sales and a price to earnings basis over at Airbnb for kind of mid to high teens growth and lumpy and inconsistent earnings over at Airbnb. But look, there are some things to really like. So we have the most recent quarter over at Airbnb. It's our second column here. Our revenues coming in at $2.1 billion. Last year, it was over 50% lower at $1.3 billion. Cost of revenue didn't budge a whole lot. You went from $2.4 billion up to $390 million. Obviously, you'd expect as your revenue ticks up over at Airbnb, they're obviously cutting a commission to the people that actually own those properties and those experiences. So you'd expect this cost of revenue to trend up in a similar direction as your revenue. Your operations and support didn't do a whole lot. up from 208, up 50 million to 258. Not bad. Product development from 349 to 375. Sales and marketing, I would have actually expected this to go up even more. It went from 315 to 379. Obviously, Airbnb has a strong brand, and I think when you are on Airbnb's website, it has a strong user interface, so they don't necessarily maybe have to market as much or spend as much money since they have that brand recognition. Certainly something that's probably factored in to the valuation when it comes to Airbnb as well. General administrative up again, not much, from 218 to 243. All of this added up to our total costs and expenses going from about we'll call that about 1.4 billion up to about 1.7 billion dollars. So yeah, we swung from an operating loss last year off of 1.3 billion dollars worth of revenue last year. We lost 51 million dollars. This year, total positive direction from 2.1 billion up to 368 million dollars worth of positive income from operation. Now we zoom over to the far right-hand column, we get a 6-month view basically from the beginning of the year to June 30th, and we see it is still a very strong 6-month start over at Airbnb, but this was a particularly good quarter because you see the income from operations in the most recent quarter coming at 368. Over the last year, you were at 363. I remember doing an Airbnb video in the first quarter, and this company was essentially at break even. We thought, well, maybe this company is at a tipping point. It appears to be the case. Flow all the way down to your net income earnings per share, 56 cents diluted in the most recent quarter. I tell you what, if this is what Airbnb thinks they're able to do, print positive net income, positive operations, keep cost under control, could be a good thing in the long run for Airbnb shareholders. Now, we talked about that $2 billion share repurchase program. Essentially, what that's going to do is probably keep this somewhat flat from a dilutive perspective, because you see over the last year, they had 611, now up to 683 in terms of your total shares outstanding. So that is weighing on Airbnb stock to a certain degree. You see over the last 6 months in terms of stock-based compensation expense, it was $442 million. If you want to annualize that number out and maybe give a fourth quarter bonus, you're actually pretty close to a $1 billion run rate on that stock-based compensation. So in some cases, this 2 billion share repurchase program essentially is going to cancel out about 2 years of stock-based compensation again, if it stays on this pace over at Airbnb. Now, from the balance sheet perspective, Airbnb certainly has the balance sheet health to certainly afford a $2 billion share buyback. You have a well over $9 billion in cash, nearly $10 billion in cash. You do have a small amount of debt down here at about $1.9 billion. That was basically flat year over year. Some of you might wonder, well, why aren't they paying off the debt instead of doing a share buyback? Well, you see, over the last 6 months, the interest expense on that debt was about $13 million, but they earned nearly $25 million from interest income. Essentially, the money sitting in their balance sheet earned them $25 million that essentially cancels out and even more than repays that interest income. So certainly a decent use of cash over Airbnb, and certainly in this regulatory environment, while this sector is used to the Expedias and the Trip.coms and the booking holdings companies, they have just rolled up dozens of websites over the year. Airbnb certainly could do that strategy, but certainly more difficult and maybe not conductive to the Airbnb brand. So certainly could be a use for cash. I just think this company could probably use that $2 billion for something else. And certainly when we look at the stock reaction down 2% on the news, just not really that exciting. Now, from a cash flow perspective, this is where it gets extremely exciting for Airbnb. For the last 6 months, we pull down our right-hand column net income number. This year, it's positive $360 million. Last year, it was negative $1.2 billion. We get to add back in that stock-based compensation, which is now looks like it's going to be canceled out a little bit by that buyback. So you did $442 million worth of share-based compensation in the most recent 6-month period. You had some depreciation and some other expenses over at Airbnb, and look at the cash flow. Last year, we thought it was impressive at $1.4 billion. even more impressive today at $2 billion. If you want to annualize this number out, understanding that Airbnb's third and fourth quarters from a revenue perspective, obviously people do travel in the third and fourth quarter, but to a lesser degree than the second and third quarter, where most families, at least here in the United States and other parts of the world, are on holiday vacation, summer vacation, the kids are out, and the weather is in generally pretty nice. But we can go ahead and annualize to a nearly $4 billion positive operating cash flows. You're still at a premium valuation to market cap, in my opinion. I mean, you're pretty darn close to a 20 times forward cash flows over at this company. That still seems incredibly rich, in my opinion, on just a marketplace facilitator website, not one of these other companies that actually own physical property that tends to increase in value as well over the years. Now, they did invest in the most recent quarter over at Airbnb, but at a lesser rate than last year on that property, plant, and equipment, from $15 million down to $11 million. They didn't do a lot on the financing side. Company continues to just add cash to the balance sheet. Last year, they had about $7.7 billion, all the way up to $9.7 billion. And in terms of cash and cash equivalents, nearly $15 billion over at Airbnb. Just impressive from a cash perspective. Certainly have use, and there is merit to this $2 billion share repurchase program, but we tend to see this on stocks that don't have this massive valuation. Now, Airbnb more recently has bottomed out like a lot of stocks, kind of late June into July. We saw this stock down here at about $88 per share. I think we're having a good old bear market rally going on in the markets, as the sellers have just made a ton of money over the first half of the year. Some of them probably not wanting to get greedy. On top of that, you had a lot of money sitting on the sidelines buying the dip. That is kind of what we're seeing here now, though. With Airbnb, the reason why I have this zoomed out to a large view is we've got this big green line here. I'm going to actually change that red, because that was support. Since Airbnb went public back in 2020, the area right here at about $132 per share, I mean, it was like a put option under this stock. For many years, it came down to 132 and then bounced like a basketball much higher, only to finally break through that level in May of 2022. And then once you break a key area of support, it's often look out below. And this is often the time you want to exit a stock. You don't always have to do it on the first red candle down. You often get a rebound trade back testing close to that range. You want to get out here, because this one traded from 132 all the way down to about the aforementioned $89 level, now back up here to 113. The reason why I have this zoomed out is, yes, this stock wouldn't surprise me, quite frankly, continues its strong momentum, but it should reach some resistance here in the probably initially at the 120 level. If it zooms past that, you should have pretty hard resistance up here at about 130. What's once was support should be now resistance on the way back up. But the other thing that I'm seeing is this could just simply be a continuation of this downtrend that we've been in, like most stocks, since November of 2021. This stock, quite frankly, in the shorter term could rally even north of 130, and you could just simply be resuming this downward trend, retest a lower area. And quite frankly, unless you do break up over probably the 140, 150 range over at Airbnb, I would actually assume this longer term trend is still intact. And until it really breaks out of it, I would just assume any rallies will likely be followed up by subsequent pullbacks. If you like this company's operating cash flows, you like the fact that they are doing share repurchase. I don't want to put this by management. This is a nice thing, and it's going to more than cancel out stock-based compensation over the next couple years. That is good for you as a shareholder. I think we do have to wonder if this stock turns into kind of a low to mid to high teens grower for the foreseeable future. What is that going to do to its valuation? I don't think there's any rush to jump into this booking and book Airbnb in your portfolio. I think you can be patient. This valuation is still incredibly rich for this company, although we are absolutely seeing signs that from an operating perspective, a net income perspective, this company is operating the business very, very well. So there's certainly some things to like, but considering you've got lots of other stocks in this situation that trade at a better valuation to Airbnb, probably focus on those first and then maybe come to Airbnb later. Hopefully you guys enjoyed today's video. I'll be back again soon with more. Good luck with your investments.